Chuck Grant, I'm the Chuck in the Markets Up Chuck, and today's blog post was titled Facts Not Fear. And what I wanted to talk about was there's been a lot of hoopla lately about Dow Jones Industrials hitting 10,000, and I think that's obviously important. I'm glad to see that it's happened. It's a nice recovery off of the lows. But what I've got here is a 20-year performance history on the Dow Jones. Unfortunately, my research tool doesn't include earnings for the Dow Jones. I get my data from S&P, and they don't provide that. But what I did want you to do is just look at it from the perspective of price. This line right here represents the Dow 10,000 everybody's so excited about. And the Dow, of course, fell from almost 14,000 in October of 2007 all the way down to 7,600. Now it's back to 10,000. That's considered a landmark kind of number. But what I would like to do is look at this from a perspective of earnings. Now, the Dow Jones is considered a proxy for the market. There's actually a proxy for the market that I like better, which is the S&P 500. And I do happen to have earnings per share in the S&P 500. And if you happen to look at this stock price, you'll see it's very, very similar to the Dow stock price. But I do have earnings here, so I want to make a couple of points. First of all, this represents the earnings per share of the S&P 500. This blue line and there's actually a green line with white triangles are the same number, approximately 15 times earnings, which is the historical norm. I do want you to know that earnings had fallen dramatically. The last time we had a recession in 2001, we had a big drop in earnings, and that was followed by some really great years where we had very large 15 to 17% growth rates in earnings per share on the S&P because they were coming off of depressed numbers. We're seeing the same thing now. We're actually starting to see some estimates. They're forecasting $71 a share for 2010. And if you look back at the S&P, and I'm going to shorten this chart a little bit because I have more detail. On the 20-year charts, we skip a year because we don't have room to put all the data. So if I look at a 15-year chart, I want you to notice that the high earnings mark for the S&P was $87.72. And that was, back here in 2006. So what I've done is I've simply gone and drawn a forecasting chart for you, and I've put, around, I took the $75 and then I grew it by 8%, just assumptions, which is less than what we've historically come out of a recession at. But I put a number that was close to the historical high of around $85 or $86 a share, and then I let it go to 95 and so on. So if you look at the market from that point of view, and if you're looking out over the next 2 or 3 years, there really is a potential to see some really good stock returns from the market. The problem is people are focused on the fact that the S&P 500 is currently trading at around 20 times earnings, and it historically trades at 15. And again, the Dow has a similar situation, but I want to point out it's because we have very depressed earnings. If we're looking at future earnings, the numbers are a little better. And I've shown you this before, but I did want to focus on it again since there's so much talk about the Dow Jones hitting that magic number. Stock prices are relatively expensive on current earnings, but current earnings are primarily behind us. The real question is what's the future hold, and on future earnings the numbers are starting to look a lot better. And so the real key is the market going to fall? It can. No one can say it isn't, but I think if you're looking out 2 or 3 years from now, as you should be, then I think stocks are probably going to be relatively cheap based on a more normalized earnings going forward. This is Chuck Garmo saying I hope they gave you some extra insights into what's going on in the market. I won't be blogging on the weekend as normal, but I'll talk to you again on Monday. Have a great weekend and appreciate you listening.